Well, hello, this is Anton Bayer and Matt Marmestein, and today is March 22nd, 2023. Today is podcast number 54, and it's reviewing our weekly brief this week titled Consumer Emotion Out of Sync to Their Spending. So this is going to be a fun one, Matt, talking about how people feel versus how do they spend.
Right. Very interesting to see how people actually react. It's not what you think.
Right. Well, let's not tip our hand too early here. So last week, the University of Michigan, they released their Consumer Sentiment Index. So they released two reports, Consumer Sentiment and Consumer Confidence. Consumer sentiment is more focused on how they feel about their personal finances and the future of the economy. So it's a Consumer Sentiment Index that they report every month. And for the first time in 4 months, it dropped and declined. Mm-hmm. And the report comes before any of the news about banking that you and I covered last week, Silicon Valley Bank and
Signature Bank.
Signature Bank, there you go.
And Credit Suisse. Yeah.
And Credit Suisse, that's the newest one. So I would expect, Matt, that next month consumer sentiment will probably be even the fifth month, maybe.
Sure. Yeah.
Second time in 5 months. So consumer sentiment is coming down for the first time. However, in looking at the chart that we posted on our website, and you're happy to look at that at upcapitalmgmt.com, but it were way below where we were on consumer sentiment from 2019. Mm-hmm. And so at that point, the index was at 100, and today we're at 63. So it's dropped pretty significantly. And what is going to be interesting in this podcast, Matt, is to look at how consumer sentiment compares to consumer spending. Right. And what we're going to identify is kind of this bizarre disconnect that regardless of how people feel, they seem to continue to spend.
Yep.
So let's go back as a point of reference. So let's just go back to recent history, the Great Recession. We don't even have to go back to the .com. That's even too far. We can just talk about the Great Recession, economic collapse, 2007 and 2008. And it was obviously, everybody knows, centered around the subprime mortgage market and a lot of the variable loans and how homeowners were jeopardized in being to stay in their home. And it unraveled the economy.
It did. Yeah, the recession was very long. And I think it was one of the deepest declines of the U.S. economy, actually. And we had poverty rate go from 12.5% all the way up to 15%, unemployment all the way up to 10% in 2009. So these are huge numbers compared to now. Largest percentage of homeowners in U.S. history experienced mortgage defaults and foreclosures. And, everyone knows about it. You know?
And the fix and flip market started because of so many homes were going to auction. At one point, Matt, 33% of homes were in default or 90 days late.
Wow.
On average, it's between 5.5% and 7%. And even now it's below that.
Right.
It was a time, but that wasn't the only thing. Homeowners, of course, were impacted. Everybody knows about the subprime, but it also impacted businesses. And so companies and institutions that were rock solid were suddenly on sand. So Lehman Brothers, 150-year-old financial company, 25,000 employees worldwide, goes bankrupt. And the government and the Federal Reserve decide not to bail them out. And so I don't know about you, Matt, but I remember watching on CNBC, people walking out with boxes of their office stuff out of beautiful office towers all around the world. Their company gone. And then General Motors and Chrysler, who the federal government did decide to back and fund. So that was potentially impacting several hundreds of thousands of employees and contractors.
Right.
And so that was a big deal that the government stepped in. And then AIG, another company that was a world dominant insurance company, the Federal Reserve came in, which was interesting. And they did a cash for stock option here. They exchanged 79.9% of the company's stock for a $142 billion loan, which is interesting. They lent the money, but they got the stock.
Right.
And that stock, after AIG recovered, netted out a cool $22.7 billion for
it was a great asset purchase there for the Feds.
Yeah.
Good call.
So consumer sentiment, understandably, in 2008 dropped to the lowest level that the University of Michigan had been reporting. So that gives you an idea of what was happening then, and understandably why consumer sentiment dropped to that low level. And for reference, it dropped down to about 53. 53 was where it dropped down to. All right, so now we bring us to our recent crisis, the pandemic. And of course, that was a dramatic situation that was not just a financial crisis, it was a worldwide viral health crisis. And at one point, I don't know if you remember this, Matt, but the WHO and CDC were projecting up to 6% of the world's population might die from the coronavirus.
Right.
And so what do you think consumer sentiment did during that time?
Well, it declined, I know, but I don't think as bad as 2008.
Yeah, it got all the way down to 72.
Oh, wow. Okay.
Yeah, so it didn't even come close to the low of the financial Great Recession demise. And
well, it shows people are more scared of financial crisis than health crisis.
Yeah, I mean,
apparently
6% of the world population was going to die.
But at least we'll have our money, right? Yeah.
So and interestingly, when you look at this chart, it dropped in 2022, but then it rallied back up to almost 90 by the end of 2021. And so the viral was still well in play. China, even just as recent as September of last year, still had full restrictions.
Right.
The zero tolerance policy that they had. So this is still well before, really, if you want to call it that, the viral threat was over. And so
what did we have going on? We had the federal government assuring everyone financially that everything was going to be okay.
Right.
Printing out money, unemployment was paying out hand over fist.
Right.
You had house prices rising, stock prices rising. I mean, that's very reassuring.
Right. Well, it's nice when you're getting double employment benefits.
Yeah.
The PPP loan, the payroll protection plan.
And the EIDLs.
Money was being handed out. And what was unique about this time period is it was being handed out to everybody, rich and poor, and companies, individuals, unemployed, everybody got money. And I guess that's going to help people in their sentiment.
Yes, I think so. But clearly, I mean, these charts show it, and the behavior of the people show it.
Yeah. We're not too worried about 6% of the world population, but we got money.
Right.
But what's interesting is the money ended late 2021, September. The unemployment bonus ended. A lot of the stimulus, the PPP, ran out. They actually didn't even pay it all out, as a matter of fact. I still get calls probably once a week. Hey, there's payroll monies that are available to you from 2020. And they don't tell you that you had to lose money in that year to qualify for that money.
All right, yeah.
But anyways, so a lot of this stimulus started running out. And as a result of that, and then the Fed started raising rates because there was too much money chasing too little goods. And so inflation started coming into play. And March of last year, the Federal Reserve starts an aggressive rate hike policy. So you have the combination of the Feds are now raising rates, which is costing everybody more money. Mortgage rates went from 3 to 7%. And government stimulus monies is drying up. And guess what happens to consumer sentiment?
I don't know. Tell me.
Well, it didn't just drop. It dropped way below the lowest point of 2008.
Wow.
Yes, all the way down to 43.
Wow.
And so, I'm sorry. Yeah, actually maybe 50, 51, but well below the worst that people felt during the Great Recession. And so it really is interesting how people's sentiment is going to be very closely tied to how much money they have. So the transition here is that we've focused on consumer sentiment, but we haven't yet really talked about consumer spending,
Right.
which you would think the two would go hand in hand. And that is not the case.
No.
Consumer spending through all of this, the dot-com bust of 2000 to 2003, the Great Recession 2007 to 2009, and then the recent pandemic 2020 to let's call it today to 2023, consumer spending has barely declined through all this time. In fact, we have a chart that goes back to 1950. And in 72 years, consumer spending has barely changed to continue increasing every year.
Wow.
Now, part of it is a little misconceiving because deceptive, because we've had more people in this country, right? So it's not like you and I are spending more money, and you can't spend money if you don't have it. So people are making more money, yes, but the population growth has also been very strong as well. But consumer spending as a whole has, with the exception of 2008, a little bit of blip there, and a fairly big blip. Obviously, we were all mandated to stay home in 2020 and 21, but consumer spending is now at an all-time high.
Right. And that's interesting because, consumer sentiment is down. And
right.
That's like basically, individuals.
The worst ever. Worst ever.
Yeah, worst ever. Right, right. And individually, that's, each one of us basically saying that, we think that economic turmoil is, upon us, and we're worried about the future. But as a society, we all still need goods, services, and we want things. Right. So what really happens is we just continue to purchase.
Right.
And so that's probably why, as you write about in the update, it's why our economy and stock market continues to increase even after volatile periods and back to record numbers.
Right.
And like you talked about over and over, 66% of the U.S. economy is our spending. Yeah. And if that continues to always go up, then our economy will continue to grow.
Yeah. And the other 1/3 is governments, nonprofits, corporations. So when people think about the stock market and watching CNBC and all that, that's less than 1/3 of our economy.
Right.
What's going on.
Yeah.
2/3 are you and I. And so when you see after March of 2009 at the bottom of the Great Recession, stock market did great. In fact, since 2012, it never went down. It never ended a negative year until last year. Mm-hmm. And the question a lot of people ask is, why does the economy and the stock market bounce back so quickly? Well, because 2/3 of the economy is consumer spending. And historically, like you said, if consumers have money, they spend it.
They're going to spend it. Yeah.
So what does this all mean to you as investors? And what's our point here? Mm-hmm. Well, as Matt pointed out, 2/3 of our economy is consumers. So we need to not pay attention so much to consumer sentiment, because there seems to be a pretty big disconnect. Right. We can't correlate how people feel to how they'll spend. They seem to spend all the time. So we need to focus on how much money consumers have, and then from there, the assumption is they'll spend it. Mm-hmm. So the good news is the U.S. Bureau of Economic Analysis reported that fourth quarter wages increased 3.2% in the quarter, following a 4.8% increase in the third quarter.
Huge.
So wage growth is there. We know that unemployment is at the lowest it's been since World War II, currently at 3.6%. And we still have 10 million jobs if there's anybody that doesn't have a job.
Yep.
So consumers have jobs. They have rising wages. Their mortgages are fixed, most people at 3% and 4%. So the biggest bill is stable. Mm-hmm. So consumers look pretty good.
Yeah.
And so what does this mean to me? Our view is that since consumers are a big driver of the U.S. economy, and consumers currently and households are reasonably healthy, that the prognosis for the future is, I think, at a minimum, modestly positive. And I think the worst is over from the pandemic. And then we're entering into the last of the third cyclical year of the presidency, going into the fourth cyclical year. And the fourth cyclical year of the presidency is usually good. Stock market loves that fourth year because politicians are too busy campaigning to do anything. So stock market likes that. So we might be in a reasonably favorable time. The Feds will probably bump the rates again tomorrow, probably 1/4 point, and maybe even one more time. But that may be the end of it. And so going into the summer, we've got the Feds pausing their rate increases. We have consumers are employed and spending, and moving into a time period of a little more stability and less variables of the Federal Reserve and other things. There's something we can talk more about the banks, but we kind of covered that last week. At this point, it appears the banking crisis is not a crisis, and but that remains to be seen. We don't want to call it too early.
No, I agree. And, the media will continue to, dwell on the negative, bank failures, new virus threats, that kind of stuff. They're going to continue to push that narrative.
Right.
And, as you've talked about over, the years, that what we really need to do is watch, institutional investors.
Right.
And what we don't have to do is we don't have to know what they know, like you said, but we have to just watch what they're doing. Because they're the real movers in this market.
Yep. And so based on the S&P 500, technically it bottomed late October, and since October of last year, it's rallied to new highs. And when it has a correction or a sell-off, it stops at a level above the previous low. So you have this stair stepping, 2 steps forward, 1 step back, since October of last year. That's very positive. The S&P and NASDAQ are both above their 20-day, 50-day, and 200-day moving average. And we talked about moving averages in past podcasts. And NASDAQ is actually in better shape than the S&P. The S&P is about 4% away from it's reaching a new high since October. And NASDAQ is about 2% away from reaching a new high since October. And that would be very good news for it to do that. That would confirm the continued 2 steps forward, 1 step back.
Right.
So it would seem at today, as we're recording this podcast, that the forecast looks reasonably good for this year, and potentially the worst being over. And so we are still maintaining our favorable view on the stock market and the economy, and looking at opportunities there. And then also there's still the benefits of rising interest rates in the credit markets, and CDs now above 5% for 9 months. I was looking at that today. That's a good rate.
Yeah.
5% for 9 months.
Yep. Fixed, guaranteed, awesome.
Yeah. No rate there. So we've been adding those to our model portfolios, and we even have a fixed income model that's only CDs and treasury bills and treasury notes, where principal is fully guaranteed with close to a 5% return. And so that gives investors some options, and options is always good for the stock market.
Absolutely. Yeah. Well, great.
Well, that's our podcast today. Summary: consumers may feel bad, but they seem to always spend, and consumers spend and represent 2/3 of our economy. So that seems to be good news there. So that's our podcast today. If you have any questions, give us a call. We'd love to hear from you. Send us an email if you have any questions or would like to talk. We'd love to do that. So signing off, Matt Marmestein and Anton Bayer. We'll talk to you soon. Bye.
See you later.